Hey guys, this is Aaron coming at you with a video about the balance sheet. We're going to do a deep dive on it and try to explain how it works and why it is so important for you and your business. So for a lot of us out there, we don't exactly understand what a balance sheet does. And a balance sheet is incredibly important, and some people think it's boring and they never go over to company and financial and go down to balance sheet and hit the standard button there and open it up because they don't know what it is that they're looking at. A lot of us get balance sheets confused with a net worth type form, and I'm going to break this down and make sure you understand it. So the way this is set up, typically you will have your assets. I was going to do an abbreviation for assets, but that would not have been appropriate. And then your liabilities, and your liabilities come all the way down and total up, and you minus them against this. So the question is, what's your net worth, right? So everybody wants to know, Aaron, I've got 30 grand in my checking account. I've got 50K worth of equipment, and we'll just leave it there at that. And then down here on the liability side, I've got 20K worth of some type of debt. Got 10K in sales tax that I need to pay. It's about to be due, so we'll put sales tax. And if I just leave it simple at that right there, then what I see. Oh, and let's say we got a long-term loan. We'll put long-term. Let's do long T. We'll do a long-term loan at 20K. So what we'll end up seeing here is a list of our liabilities, and as a normal shop owner, we're trying to grade ourselves all the time. We go, what are our assets? 30,000 and 50,000. Of course, this is if you don't own your building. We're not going to go there right now. So we have 80,000 total assets. What are our total liabilities? 20 plus 10, that's 30, plus another 20, that's 50. Well, 80 minus 50 is 30. Wow, it's huge, right? So we see our net worth is 30K. Here's the problem. When you go down to the bottom of your P&L, it doesn't say that. Instead, your P&L will say, let's see, 130K. This is one of the things most people get so confused over. And it will say total, and it will say total liabilities, and I'll do equity, or it will say total liabilities and assets, whatever, and it'll have equals 130,000. And people will go, wait a second, Aaron, I've got a total here of 80, and I have a total here of 50. How come that minus that equals 30? How come that's not what I see, and instead I see 130? Well, this is why. If you understand how a balance sheet works, your balance sheet tells you the balance of all of your accounts. So credit cards would be listed under liabilities, the total balance you owe. Your checking account, total balance would be there. It also, how am I going to do this? Let's do, I guess I'll draw it here. It also is connected to your profit and loss statement. And because it's connected to your P&L, and these two are bedfellows, what ends up happening is when you make a change here, you see the change here. And if you make a change here, you see the change here. Why? Well, because we follow GAAP accounting, which is generally accepted accounting principles. These two must always balance. So what you do here must also reflect here every time. So when you open both of these up on your QuickBooks, if you could spread it out on your screen, you made a click and change one, you would see the same change over here in the opposite form. So I'm going to walk you through what I mean by that. This is going to tell you the balance of all your accounts. That's why it's called a balance sheet. Your balance sheet also is the total of dollars circulating. No one ever goes into this, and I always kind of felt like I needed to hear this. So I'm going to do, these are your two main things that your balance sheet does. And I always felt that if someone had explained it like this to me, I would have got it way long time ago, instead of when I did finally get it. So when you look at all of your assets and you look at all of your liabilities, you had to have this money in your checking account, right, to say you had that money in your checking account. You had to borrow this money here, right, to be able to go do business. You had to buy an alignment machine, you had to have sales tax that came in, then you owe it, it's still sitting in your account, et cetera, et cetera. Now, if you were to go pay your sales tax, that $10,000, what would happen is that 10 grand would evaporate off of your liabilities, and then your 30K in your checking account would drop, because everything must balance, down to 20. Very simple. But if we were to do the advanced math on this and understand how money circulates, if you can imagine a circle, it takes that 80,000 plus it takes that 50,000 to create the given company that we have mapped out on this balance sheet. So it's a total of 80 plus 50. So your total liabilities and equities 130 grand, or your total liabilities and assets are 130,000. That's the total amount of money that's circulating in your business. Either an account money that's owed out that people have given you credit, like the state of Tennessee would give you credit if you did business here. They would allow you to collect money from your customer, not send it to them for 30 days. They've issued you credit. And then your credit card is issued you credit, or a charge account, whatever it may be. And the same thing on assets, right? If you've got 50K in a savings account or 50K worth of equipment, and then you've got 30K in a checking account, all of that is represented here. And some of this long-term liability might be represented in this equipment. Maybe this has been paid down somewhat. What you need to understand, though, is that this is the total of the two. So if you go open up your QuickBooks and you see this amount and you go, why does it not match? It's because net worth is not the same as the total amount of business that's happening inside your company. The total amount of business is all the debt and all the cash. It's all the positive and all the negative. That's the whole thing that makes up your whole pie of your business. The net worth is if you liquidated it all, is this what you would have? And the problem with net worth is that's if you sold it normally. When does that normally happen? It's usually a fire sale because somebody dies, and then you usually don't have this. So whenever you're trying to figure out your own net worth, be very conservative in your assets. What would you actually sell them for? You'd probably sell for a lot less. Now, if these are the two main purposes of a balance sheet, it tells you the balance of all of your accounts. So you could grab anybody else's balance sheet and you could see how much money they have, how much debt they have, and be able to check the health of the business. It would also tell you how much is circulating, how big this pie is that you're trying to grab a hold of and manage. That P&L, it must balance with this. So I'll see a lot of guys that say, Aaron, I have a mortgage. And on my mortgage, on my P&L, it's in my overhead section, and my mortgage is actually $5,000 a month. But I only have for my mortgage listed here $1,000 a month on my P&L. So my net, is $15K, but I know in reality it's not really $15,000. In reality, I know that I paid $4,000 more. That's the actual check I wrote to the bank, right? This was the check. It had the little signature on it, my signature underneath. That was the check. So if that check was written to the bank for $5,000 for my mortgage, but on my P&L only $1,000, it ends up inflating this by $4,000. So if I was to minus that $4K, I really only made $11,000. This is why we suggest people that own their own real estate have it in a separate LLC and then do a lease to their business so it matches here for the P&L sake, but also because your property is only worth the value of the lease. And a lot of you right now are discounting the value of your property, and you're hurting the overall value of your business by doing this because you're showing yourself that you're doing more than you really are. For example, a guy will tell me, Aaron, I'm making 20% net. By the time I go in there and actually put in all of his mortgage data or charge himself a fair market lease and his own paycheck, I end up finding out that he's only making 5% net. The only reason he happens to be making a 20% net is because he's got his building paid for, or he's only got the mortgage principal or interest alone showing up on his P&L. So let's break this down. Your mortgage interest will always hit here because that's an expense. But when you pay that interest payment, that money just flies out the window, right? It's gone, goes to the bank. When you pay the other $4,000 that's not showing up here, which is inside of this, that $5,000, when you pay that, that actually drops the liability. So if you have a mortgage listed right here, let's say it was the $20,000, that mortgage would then drop by 16. So when you cut this check, your P&L will have $1,000 interest. Your debt right here would drop by $4,000, and you would see the total of $5,000 disappear here and here, and that's how it balances, right there. Now here's the kicker to all this. A lot of guys don't know that they need to add that here mentally back and just basically get your P&L, print it, take a red pen and use red for changes. Go down here and minus it and give yourself a true number. Oh crap, I only made 11,000. Don't lie to yourself and tell yourself you made 15. Yeah, you made 15 worth of value because you paid your mortgage down by another $4,000. The problem is that's not how much business or how much cash your business actually made after it paid everything. That's why it's good to always charge your business rent. Now, these two, the way they are associated, the way they're connected, it's a huge, huge deal that you understand this and can open them both up on QuickBooks, go hit vendor, pay a bill, and watch them change. It'll help connect the dots in your head. This is the balances of all of your accounts, positive and negative. When you pay a debt, your checking account drops. Also, the liability drops. And depending on the type of debt it is, the interest will show up right here on your P&L. The balance of your accounts are very, very important, but what's more important is the total of cash that's circulating in your business. If you have a total amount of cash circulating in your business all the time of $100,000, that means when you add all of your assets and your liabilities, you're going to see that 100K show up right there. Whenever you see that 100K show up, you're going to look at it and go, okay, I've got $100,000 in cash churning all the time. And for a lot of you, they're trying to figure out how much cash your business is sucking up whenever you're in growth mode. This would give you a lot of those answers. You know, for Thomas and TJ and Guy and myself and all the others, it's hard for us to know exactly on your business until you've worked with us for several months. We've been able to wrap our head around your business and understand what's going on. But you guys could look at your own business and figure out exactly how much cash you got tied up and what's being churned over and over and over. This is a big deal. Now, I want to bring up Thomas to help me with this because I feel like there's a lot of people that still don't get these dots connected, and I feel like explaining it a couple different ways is always helpful. Thomas, thank you. So I've lined out the balance sheet here. I've lined out the P&L here. I've explained if they pay a check,
Right.
$1,000 goes to interest, $4,000 can come right here off their debt or their long-term liabilities, but off the liabilities section.
Right.
And they would be able to say, where'd that $5,000 go? Where 1,000's here, 4,000's here. Simple math.
Right.
And these two, how they're tied together.
Right.
And then we went through how the assets and liabilities, and you add them all up, equals your total that's churning in the business right here at the bottom, and how that is totally separate from your real net worth.
Right.
And your balance sheet will not tell you your net worth. You have to manually minus the liabilities from the assets. It will never tell you automatically. And the bank a lot of times will want to know when you apply for a loan if you have net worth. And when you have net worth, it's also basically positive equity.
Right.
So for a lot of people, I don't want you to worry about trying to understand how the equity goes up and down because you can do a lot of owner equity pay and everything else, but we'll get into that at another time. A lot of variables there.
Yep.
And depends on if you take owner draws or you pay yourself a W-2 or a combination of the two. But take a look at this and you tell me from your perspective, when you get on the phone with the average shop owner, what is normally where they get so confused on this?
Yeah, so the first thing I see when I look at a P&L is sometimes whoever's doing the books, whether it be the owner or somebody else, they're putting things that should be on the balance sheet on the P&L. So I was looking at a P&L.
Let's do an example.
Yeah, so the other day I was looking at a P&L, and so you know that any time that you pay an employee, there is your portion of the payroll tax, and then there is the employee's portion. Well, I saw that they were putting both portions on the P&L. So what's important to note is that yes, the amount that's leaving your checking account on the asset side includes the employee portion, but that's not really your expense. You're pulling that out of their paycheck. It's getting stuck on the liabilities for just a second, and then you're cutting that check back to the government. It's a remittance, like a sales tax.
So let's say it like this. So the owner, you paid him the employee, you paid him $1,000 paycheck.
Right. Your gross wages would be $1,000.
So we went and gave this employee.
Give him a little paycheck there, a little stub.
Well, we gave him a $1,000 check.
Yep.
He goes to cash this check, but it's not really $1,000.
Right.
It's really, let's say, $900. And there's $100 that we kept for him, and we mailed to the government as a favor,
Right.
we'll say.
Right.
Even though by law we have to. But as a favor,
Yeah.
we
real nice.
we gave him a check for $1,000, but
Right.
really, it'll have on the check stub all the little taxes, the FUTA, FICA, ABC,
All that crap.
EFG, whatever.
Alphabet soup.
Alphabet soup, all those deductions, and we'll just say clean, it was $100.
Yep.
But now that we pulled that out of his check, we're supposed to mail it for him. And if we don't mail it that day, it shows up as a bill in the liability section. And then what happens?
And then you cut the check. Your assets would be reduced, and then
So we would drop by $100 in our checking account.
Yep, and then because remember, you have to have an in and an out every single time, double-sided accounting, and then your liabilities would decrease by the $100 because you've paid that remittance back to the government.
So the key to this whole thing is, though, the $100 for the employee.
Right, that's their expense.
Because
they're on their P&L if they had one.
So because it came out of this paycheck, and it dropped to $900.
Yep.
We also have to do what's called matching taxes.
Super fun.
Super fun.
Yeah.
So the way it works is their income tax just comes out of theirs. But the actual Social Security, Medicare, et cetera, is split between the two of us, 7.5%, 7.5%.
Right.
So a total of 15%. So this paycheck, we'll just say for easy math, what it actually comes out to is $1,000 is what we paid the employee.
Earned wages.
The employee then had to cut $100 to the government via us, right? Via the owners.
Being super nice.
They took home $900, but then we had to match that $100.
Right.
So because we had to match that $100, that $100 showed up again here. So it shows up as $200 that needs to go to the government.
Yep.
Because we matched it. So that check, instead of being $1,000 to that employee, what the employee really costs the company is $1,100.
Right.
And so because of that, this particular shop you were talking to, we had, well, hold on, let's do, we had the matching 100. It was for us.
Yep.
That shop, you're saying, put the employee's $100 and the matching 100 on the P&L.
Correct. It never went on the balance sheet.
So instead, this $100 should have gone immediately to liabilities. So it'd be like a vendor that you owe, and just like you owe
anybody else,
AutoZone or O'Reilly or
Yep.
Napa or whatever.
Yep.
And then this $100 would have been also a vendor that we owe. It would have shown up, but it would have only that one would have reported on our P&L under the payroll tax section.
Right. Yep.
Cool. And they reported both.
Yes.
And the reason, well, there's several things happening wrong there.
Right.
I won't even go down that path.
Right.
But we have to make sure we account for the two of them separately, accurately,
Yeah.
because then we start looking at our P&L, and if we actually think that's what we owe, we go, crap, employees are expensive, Thomas.
Yeah.
Why do I even got them?
Well, and your profit on paper is incorrect. It's
and then we
lower.
look like we made less money.
Right. Another one that I see, so just on this note, one way that you can kind of think through this, and always talk with your CPA or whoever is kind of looking over your books as you're talking through these things.
We're not accountants, by the way.
Official, right, yeah, we're not accountants.
You can't sue us for nothing.
So, anytime that you are taking money from someone, whether it be a customer, an employee, and you are then turning around and remitting that same money back to someone else.
Child support.
Sales tax.
Payroll tax.
Payroll tax.
I think that's pretty much it.
There might be a few others. But so another big one I see, and this is a really tricky one, is sales tax. So if you are just recording your income based on your checking account.
I'm so glad you hit this.
Please don't do that, by the way. That's a really easy way to get stolen from. So if you're just saying, well, on the checking account, I have, for easy math, $1,000 come in. Well, that $1,000, assuming your state has sales tax, there's a couple that don't, assuming your state has sales tax, includes, that $1,000 includes what's actually a remittance that should be going back to the state. So what you really earned is maybe, $950.
So let's break that down a little bit further.
Okay, great.
So let's say that total revenue right here was $100,000 on the P&L.
Right.
Then you looked deeper and you go, oh crap, they really did $95,000, and they're reporting the $5,000 in sales tax as revenue.
And it gets trickier. So the way that I discovered that is I saw down in the expenses, sales tax. So here's how that could work. Now, if you truly are, collecting or noting, let's say $100,000 in actual money went into your checking account, then it would be correct, technically, to expense out the.
I'm going to break this down even further.
Okay.
This is.
You know where I'm going?
I know where you're going.
All right.
And we need more room.
All right.
We got to make sure everybody can follow, and you make sure you keep talking loud.
Okay.
So this will be our new P&L, just so we don't confuse everybody. This is the good stuff right here, because so many people get this messed up.
Yeah, they do.
And they
It's
think
easy to do.
well, and they think it's still right. You can argue with them for 30 minutes about it.
Yeah.
So we'll say that they've put down $100,000 in income.
Which is what came from the checking account.
which came from the checking account, or whatever other, or they took a business summary,
Right.
which says the total. A lot of shop management software, by the way, we'll hit this
That's
in a
a
second.
good point. Yeah.
A lot of shop management software reports average RO, total
That's
gross
great.
sales, even
Yeah.
GP,
Yeah.
including sales tax,
It's
which
not
is
your
so
money.
stupid.
It's not your money.
money.
Yeah.
It should never be counted. So, well, it should be counted. It should never be counted inside of revenue.
Yeah.
So that being said, it says 100,000. You're just the coach. You think everything's kosher, and you start digging in. You go, oh crap!
There's 5,000 in expense down here for sales tax.
And then down here, well, not just that. You find this difference is $5,000.
Yeah. Yep.
Right? But then you see in the overhead section a $5,000 bill for sales tax.
Yeah.
And they go, well, Thomas, it's a bill. Why shouldn't it be there? What do you say?
It's not a bill. It's not an expense. So
Why is it not a bill, Thomas?
Because it's not your money. You collected it.
Tell me more, Thomas.
Wow. Don't be that way if I'm your coach, please. So the thing is, you are taking that money from the customer. They're handing you $1,000, for example, and of that $1,000, what you have earned in your repair is maybe $950. At the bottom, it says sales tax is $50. That $50 is not a bill. Just like we take money from our employees and we give it back to the government, it's not our money, it's their money and it's their expense. That sales tax is technically the customer's expense. So we are, on behalf of them, taking that $50 in that example, and we are going to pay it to the government.
And it goes maybe into the same checking account.
Oh, yeah.
But on QuickBooks or whatever financial software you're
Right.
using, it goes into a make-believe account.
Right.
And it's a total amount that's piling up throughout the month for the state.
Right. So if you are taking the income recorded from the checking account and it includes sales tax, then technically, for this to be balanced correctly, you do need to subtract sales tax. But the problem with that is that this $100,000 is not actually what you earned through the performance of your business. It's just the kind of like cash versus
So it
accrual. It's
throws
the
off
cash.
every single percentage.
Everything's screwed up. So what's even worse though is if they recorded the $95,000 and just when that check hit the bank account for sales tax, they went ahead and hit that too. I've seen both ways.
Oh, you've seen it where it records 95, and then they also make a $5,000 bill and it goes down to 90.
It would be very easy to do.
Okay, so let's take this a step further and build on what we've been teaching. So if you have a memorized transaction in QuickBooks, this is why this is so
We're
important.
going to teach on this.
You want a daily memorized transaction, a blank one already in QuickBooks where you enter your day in every day.
This is just a template. QuickBooks calls it a memorized transaction.
You're going to have your total labor, your total parts,
And this is sale.
you're going to have your sublet, and you're going to have your, we'll just call it tax for short, not sales tax. So you have your total tax. Now you might have labor that's taxable, labor that's not taxable, all those different categories, but what's
Yeah.
going to happen is you will have 4 categories. Labor, parts, sublet, tax. That's it. Some of you will include sublet with parts, that's fine, but that's all you have. And so it's those 3 or those 4, whatever, but parts and sublet are the only 2 that can be combined. So what that means is that tax is always funneling off into this little make-believe account, okay? And this tax account piles up, and that's where we record our tax revenue. But all of our normal revenue, all of your parts, sublet, and your labor, that all records into your normal revenue on your P&L, right here. So you would never on the standard P&L ever see, ever, you would never see a tax bill on a P&L because that money shouldn't be here. That money should be dumping off. It should never go through this. It should dump off into its own account beforehand.
Talking about sales tax, yep.
Yeah, so any kind of tax that's based on revenue. So
Right.
yes, sales tax. It should go over here. Now, a property tax, that would hit here on your P&L. You know, any kind of other
Business tax.
personal property
Right.
tax, revenue tax
Right.
will hit your P&L.
Mhm.
But sales tax, which is recorded off of what you sold to customers, you were just collecting that money on behalf of the state.
Mhm. Right.
You're just a temporary holder of it. And you
Helping
send
out.
it off. That's it. You're helping out. So that tax is recorded separately before this ever happens. And if you mix these two together, guys,
It's bad. All your numbers are off.
it'll make your GP look crazy,
Everything's screwed up.
your net look crazy. You'll never be able to do it right. And the sad thing is we've seen bookkeepers even set it up like this.
Yeah.
You got to get a
Scary.
QuickBooks Pro advisor that's been trained on this stuff.
Yeah, other easy ones to screw up is credit card bills. You know, you're just paying the credit card bill and putting it as a line item versus it being from
A
what
separate
you put on
account?
it. Right. The only thing
You
you
have to
should
treat
do-
a credit card like a separate checking account.
It's like and so you treat it, like a mortgage, in that you'd have the only thing that would be on here would be the expense because
The interest.
Right.
Only the interest would hit your
right,
P&L.
Right.
And then what would happen is it would be a debt here, and when you paid it, your checking account would drop by $5,000, and then your debt would drop by $5,000 as you
Right.
paid it.
Mhm.
All right. So this has been, I hope, helpful for everybody. I hope they've understood this. We definitely went a lot deeper than we did last time.
Yeah.
I want to make sure that everybody understands, though, no matter what, if you got anything out of this, do not record sales tax as revenue. It ain't your money. And then make sure you understand that your total assets and liabilities, every single time, that is what makes up that total number at that balance sheet that you've always wondered, where does this come from? It doesn't match anything. And then make sure you understand manually how to do your own net worth to factor in your own equity in the business itself. And then your P&L, make sure when you're paying those mortgages, make sure when you're paying those taxes that it's showing up correctly. You don't lie to yourself in the net profit, because if you do, your money will never line up, it'll never match, you can't grow your company.
That's right.
All right, guys. We'll see you
In the next video.